Welcome to this in-depth global market analysis. In today's comprehensive video, we are taking a deep dive into one of the most influential forces shaping financial markets across the planet, the economic decisions of the United States. Whether you're trading gold, Bitcoin, or Forex pairs, whether you're an investor, analyst, or simply following global markets, understanding how U.S. policy works is absolutely essential. The truth is simple, the U.S. economy acts as the central engine of global finance. Every shift in U.S. monetary policy, every adjustment in interest rates, every change in taxation or trade decisions creates ripple effects that spread across continents in seconds. Markets react instantly, sometimes violently, and understanding these reactions can be the difference between profit and loss. So let's break this down in a detailed and structured way. Interest rate policy. The heartbeat of global finance. Interest rates set by the Federal Reserve are arguably the single most powerful driver in the world economy. When the U.S. raises interest rates, the dollar strengthens because investors flock to higher yields. A stronger dollar typically pushes gold downward, as gold is priced in USD and becomes more expensive for global buyers. Forex pairs such as euro to US dollar, pound sterling to US dollar, Australian dollar to US dollar often experience sharp downward pressure due to wide rate differentials. Bitcoin and other cryptocurrencies often feel liquidity stress because higher rates reduce speculative capital. In contrast, when the Fed cuts rates or signals slower tightening, liquidity flows back into markets. Investors shift towards risk assets, pushing Bitcoin, stocks, and emerging market currencies upward. Gold often shows strong bullish momentum due to a weakening dollar and rising inflation expectations. Traders see increased volatility and clearer trend opportunities across major currency pairs. Interest rate decisions are so powerful that even a single sentence in a Fed statement can move trillions of dollars. Inflation and monetary tightening. The trigger for market volatility. Inflation in the United States doesn't just affect American households, it influences global pricing, commodity markets, and cross-border investment flows. When inflation runs high, policymakers are forced to tighten financial conditions through rate hikes or balance sheet reduction. This often increases market volatility, especially in equities, commodities, and crypto. Gold typically reacts instantly because it has long been considered a safe haven and store of value during inflationary periods. Bitcoin, although volatile, often becomes a speculative hedge against currency debasement. The release of U.S. inflation data, CPI, PCE, wage inflation, often becomes a global event. Millions of traders watch these reports simultaneously because they directly influence the Federal Reserve's next move. Trade policy and geopolitical strategy, shaping global sentiment. The United States plays a leading role in international trade agreements, sanctions, tariffs, and global strategic alliances. When trade regulations change or geopolitical tensions rise, market uncertainty increases. Safe haven assets like gold and currencies like the Japanese yen, JPY, often strengthen. Riskier assets, especially Bitcoin and tech stocks, may enter periods of turbulence. Investors often reevaluate emerging market currencies and shift toward defensive positions. Trade tensions, supply chain disruptions, and international economic policy are no longer regional issues, they influence every sector from energy to technology. The specific impact on gold, XAU/USD, gold is uniquely sensitive to U.S. economic data. Key triggers that can immediately move XAU/USD include non-farm payroll, NFP. Strong jobs equals stronger USD, weaker gold, weak jobs equals bullish gold. CPI inflation reports, higher CPI can boost gold as inflation hedge. Interest rate decisions and FOMC statements, the most powerful drivers of gold trends. DXY movements, a rising dollar weighs on gold, a falling dollar fuels rallies. In times of economic uncertainty, recessions, geopolitical tensions, financial crises, gold often becomes one of the first assets to surge. The role of Bitcoin and the crypto market. Bitcoin's relationship with U.S. policy has grown dramatically over the last decade. Bitcoin tends to rise when monetary policy eases. Liquidity expands. The dollar weakens. Investors seek alternative assets. Bitcoin tends to struggle when rates increase. Liquidity dries up. Regulatory fears intensify. A clear and stable regulatory environment in the United States often leads to long-term growth and institutional adoption, while uncertainty leads to massive volatility. Impact on the Forex market. The global currency domino effect. The U.S. index, DXY, acts like a gravitational center for the currency world. When the U.S. economy strengthens, USD pairs show strong directional trends. Emerging market currencies often decline due to capital outflows. Euro to US dollar to Japanese yen, and pound sterling to US dollar enter powerful trending phases. When the U.S. economy slows, volatility increases. Traders see major breakout opportunities. Safe haven flows shift towards yen and gold. Understanding U.S. economic momentum is essential for any Forex trader. Final outlook: what lies ahead for global markets? In the coming years, global financial markets will remain heavily influenced by the direction of U.S. interest rates, inflation levels, fiscal and monetary policy, regulatory developments, global economic strategy for traders and investors. This means more volatility, more opportunities, a greater need to stay informed, faster reactions to U.S. data releases, increased market sensitivity to policy speeches and economic indicators. The world economy is evolving, and the United States remains at the center of this transformation. Thank you for joining this extended international financial overview. Stay prepared, stay informed, and subscribe for more global market insights.